Alright, so this is a continuation of the course, and what I'm doing is just going over the Wyckoff course. Alright, so a little background. I think we covered up to around here. Up to around here at the top of the trend. So this is very important because over here I'm going to be going over how the trend turns. Much of this can be applied today. In fact, every concept here can be applied today. It happens all the time. Later on, I'm going to show examples of how it happened. Um, I think it was like about two uptrends ago on a daily chart. I'll show that, but later on. Right now, I'm just trying to focus on the course and go over all the principles that are needed. All right, so over here. After such a prolonged rise, we may expect more of a substantial reaction than we have had in the December-February bull move started, and perhaps an important decline because there have been evidences of distribution. What is he saying? He's saying there's evidence of distribution. So distribution doesn't just occur at the box at the top of a trend. All right, where did distribution occur? Distribution occurred first and foremost right over here. You see where you have this straight up movement right here, straight up. It looks like a breakout, and then you have more volume on the follow through, and then all of a sudden you have all of this volume right here, and there's a lack of progress in the closes, meaning the closes don't really make much progress. You see from this bar to this bar, look at the progress. Look at the progress, look at the volume. That volume is yielding a result. That effort, that volume is yielding a result, meaning there is progress. Now, similarly, you have similar volume, almost the same. Where's the result? Where is the progress? Where is the movement? Why? What happened? What happened is it's that demand is meeting sellers. Here, it didn't meet much selling because the demand was able to make progress. Here, it is meeting selling because it's unable to meet progress. So there is some preliminary distribution. There's evidence of distribution. This is evidence of distribution. There was other evidence of distribution, but that was really at a swing level, like over here. It's just a minor buying climax, and that's a little bit different. All right. And we went over like what this is and then why this sideways movement occurred and all of that. But this is like the real first evidence of distribution as the progress of the trend continues. You can see, look at these three bars, their volume is sticking out like a sore thumb. It is very high relative to the trend. Here you had accumulation, you see, and then rivaling that volume is right here where you had initial distribution. After that, we said, is that enough to change trend? Apparently not. Why? Because as it went down, the volume shrunk. That low volume pullback means that there's another rally coming. Why? Because it's a bullish indication. It's a bullish indication because the tried to go down, but it couldn't. So you had this attempt right here, which was stuffed by the bears right here. And this, what he said about this is that price is at a critical position. This market is at a critical position. It is about to go down possibly, but because you have multiple indications. This was a bullish. Look at all the indications. This is the indication of distribution, so that's a bearish indication. This is an indication of a bullish indication because of a low volume pullback. This is an indication, a bearish indication, because of that immediate reversal. The attempt to make a high failed and was immediately reversed. This over here is a bullish indication because it's unable to have follow through. The red bar right here is unable to have follow through, and the price is able to rally away from it. This is why this range is very, very, very confusing, and you don't have enough. All you have is like back and forth, bullish and bearish indications. Very difficult to read. So, you don't establish any longs, any shorts yet. And most real scenarios are like this. You're bullish and bearish when it is in a consolidation range. So it's better to just step back for a second until you have more clarity. Now what you have is a hypodermic maneuver. Bang, 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 right here. Up, 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 up. So we'll talk about that and what that means. Alright, so he says here, bull move started and perhaps an important decline is about to come because there have been evidence of distribution extended far back as February 10th. February 10th is right here, right there. That again, high volume, lack of progress in the close is a indication of distribution. Also note that its background included rally, 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 rally. So it's like they're selling high. The best prices, high up. So it goes up, 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 and then sell. And remember, this is the averages. This isn't a momentum stock. So this is where initial distribution took place. As Wyckoff explained right here, there have been evidences of distribution extending far back as February 10th. By the way, later on when we do the point figure, a lot of times you want to take a look at that initial distribution area in order to be able to do the count. But that's a side note. Alright, so the closes are almost identical with those of the previous day. So again, I mentioned that lack of progress in the closes, high volume equals distribution. The market therefore is making no further progress upside on heavy volume, but demand is still enough to hold it within the previous range. However, we note clearly lower top, lower bottom, low close, and some but not very large distribution, very large shrinkage in volume. The significant feature of this day's action is that it marks a pronounced change of behavior. This is very important to discuss because this right here is a change of behavior. It's the first time we talked about a change of behavior. A change of behavior very similar to a sign of weakness. What it means is that up here is the first time you have a pullback or pullback with high volume. The pullbacks prior to this had low volume. The behavior of the pullback prior to this bar was low volume pullback. This is the first time where you have a high volume pullback. That is why it's a change of behavior. The behavior meaning low volume on the pullback. That behavior has changed to high volume on the pullback. It is the first time since early December that the volume had remained so high on the reaction. Therefore, volume up to now or heretofore, volume was low, but this volume is high on the pullback. So that is the change of behavior. The fact that price cannot continue to advance into new high ground combined with comparatively high volume leads us to conclude that the big fellows are unloading. So let's take a step and see what he's talking about. Here also, you have a bar. The volume is very high, relatively speaking to the background. It is very high. It's about 4.5 million. The highest volume we had was on that climax bar, which was like 5.5 1/4. This is about 4 and 3/4. I mean 4.75 million. So you have all that volume, and again, no progress in the closes. You see, the same logic that he's using over here, lack of progress in the closes, is now being applied here, but in terms of a new high. Okay, so look at this. The fact that prices cannot continue to advance to new high. Okay, they cannot continue to advance to a new high combined with the high volume. Bang, high volume, no new high equals distribution. Or as he says it, the big fellows are unloading. So how do we detect distribution? First, over here, lack of progress in the closes, evidence of distribution. Here, no new high on heavy volume, also evidence of distribution. 3, high volume up on this quote-unquote upthrust that is unable to hold, meaning it is immediately followed by a red bar, also evidence of distribution. So we have multiple indications that help us determine distribution, one of which is lack of progress in the close based on high volume. The other is extremely high volume thrust up that is unable to hold because the close right here on the bar after it is less than the prior 2 days, which means the net gain that was made in the prior two gains has been lost. So that behavior is also evidence of distribution. Finally, this right here, where you have a bar on a lot of volume that is unable to make a new high and has a lack of progress in the close, is also distribution. These are some of the manifestations of distributions. Now, what you're taught online is that it needs to look like a box at the top with the X's and O's. Not necessarily the case, especially if you're just looking at a bar chart. How are you detecting distribution? You're detecting distribution by taking a look at the result of the volume. When there is high volume, okay, that's the first thing to look at. What is price doing? Is it making a new high? Is it staying in range? What about basically you have a bar, it has a high, a low, and a close, right? So those are the three pieces you want to look at. High volume, what is it resulting in when you're looking at the high, low, and the close? When you're looking at the high, you want to see if that bar is making a new high. If you're looking at the close, you want to see if there's progress in the close. That's all. So the result of that volume is helping you understand whether there's distribution or not, whether that demand is meeting selling. The fact that prices cannot continue to advance into new high ground, combined with the comparatively high volume, leads us to conclude that the big fellows are unloading, and the relatively large volume on the reaction of the 27th indicates that they're filling up on the buyers on the way down from the highs with what they were unable to sell in that range. All right. So I'm going to explain this. Here you have high volume on the way up. What does it mean? It means they're distributing on the way up. Now, the CM will continue to do this until buyers are not willing to buy at high prices. So what is he forced to do? He's forced to sell at lower prices. So sell on the way up until buyers are exhausted. Then you got to sell on the way down. So that's why you have a green bar followed by a red bar, with heavy volume, because you're selling on the way up and then you're selling on the way down. The CM is selling at the best prices, the highest prices, until he can't sell anymore, and then he sells on, the next to best prices. Okay, even when they're keeping it in that range, high up, on high volume, he's still distributing, still selling, because those are the best prices. You want to sell as high as possible. Basically, buy low, sell high. You want to sell as high as possible as you can. And that's what he's saying right here. The fact that prices cannot continue to advance to new ground, combined with the blah, 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 and relatively high volume on the reaction. Okay, here we go. Here it is. Indicates they are filling up all the buyers on the way down from the highs with what they were unable to sell, in the range 168 to 173. 168 is, where the hell is it? Hold on. 168 is, this is, I think, 167. So 168 would be around here. Probably the low of the climax bar, right? And 173 should be the high of the climax bar. So that's the range that he's talking about, is this bar right here. So whatever they can't sell in the climax bar range, they have to sell in the next here. Now it's holding the range, right? It's holding the range, but it's not the highest prices. That's all he's saying. The fact that price cannot continue to advance to new high ground, combined with, right, I think I've already went over that. All right, so they're filling up all the buyers on the way down from the high of the climax bar with whatever they were unable to sell in the range of the climax bar, which is 168 to 173. So sell on the way up, then sell on the way down. We must bear in mind that prices have now advanced a lot, and this is a big rise in the averages, because such a rise indicates many individual stocks used to making up the average had advanced nearly double that amount. All he's saying is, look, this is a market average like the SPY or the ES. What that means is if the market has advanced that much, imagine how much a momentum stock would have advanced. It would have advanced double that amount. Now he talks about also the angle of the advance. So this is another concept called speed. All right, the angle of the advance is parabolic. All right, so angle of advance as shown by placing a ruler along the lines at the bottoms of February 5th to the 18th is such that it cannot be maintained. So he's taking a look at around February 5th, like right there. That angle right here, like it's pretty acute. He's saying that this angle of acceleration cannot be maintained. Alright. This is emphasized by even sharper angle from the 18th to the 24th. So if we draw a trend line from this low to up versus this low right here, up, we notice that the angle is getting steeper, it's getting more acute, it's getting sharper, it's going up at a faster rate. When the support points were considerably away from the previously established diagonal support line, this is called, what he calls this is the sudden whooping up of prices after such an advance suggests hypodermics. Very important. Another concept in distribution is hypodermics. Hypodermics is a parabolic move straight up. Hypodermics is also evidence. It's not evidence, but it's it's a behavior that you find in distribution. Why? Because there's going to be selling at the highest and the best prices. So this is a hypodermic maneuver that goes straight up. It's going straight up, allowing the CM to sell at the best available prices. So it benefits the CM by giving him an opportunity to capitalize on FOMO of market participants and sell at the best available prices. So the application of hypodermics, which combined with the high and expanding volume increases the market's vulnerability to heavy realizing sales and likewise increase the danger of a general withdrawal of experienced operators who refuse to buy at these levels. Now, would you keep buying a high in anything? Like, no, you want a discount. You want a sale. Similarly, when you have traders, professionals, they want a sale also. They want a pullback. They don't want to keep on buying highs because highs are the worst prices. Here what you have is Wyckoff saying that you have all of this volume, you have a parabolic or hypodermic maneuver that's whooping up prices. That makes the market vulnerable to heavy sales because of another reason, and that other reason is smart money's not going to buy high. They're just not going to do it. So they refuse to continue to buy at these elevated levels. It is such conditions as these are the conditions that are detected by floor traders and outside professionals and recognized as indication of a trend's turning point. All right, the latter now add to the supply getting out of their long stocks and taking short positions, thereby not only helping assure a turning point and also placing them in a position to profit by that downward swing. All he's saying is smart money is not going to buy this high. And they're not going to buy the pullback. What they're going to do is establish short positions. They're going to exit their longs and establish shorts. What is the evidence that they're doing this? Because obviously if you see a stock market or any market, right, and it's going straight up, you don't know if the market's going to end there. You don't know if there's going to be a turning point there. It can continue higher. Bitcoin, case in point. But what you have here was a change of behavior. So let's take a look at this background before that change of behavior to see what's going on. First, preliminary distribution has occurred. This is evidenced by the lack of progress in the closes with high volume. Second, price has now accelerated, and it has made this high with the highest volume in the trend. That high, that bar, has the biggest volume in the trend. Certainly we would say it's climactic up to now. Okay, after that you have the highest volume in the trend on a down bar. Okay, what is all of this saying? It's saying that this is a turning point. It is a turning point because you have A, preliminary distribution, you have B, hypodermic maneuver, you have C, a climax with the highest volume on an up bar in the trend, followed by the highest volume on a down bar in the entire trend. That means they're selling on the way up and selling on the way down, profit taking on the way up and profit and establishing short positions on the way down. Given all of that evidence, you make the conclusion that there is a turning point in the trend. It's not just based on one bar. It's not just based on two bars. It is based on the entire trend. The entire trend, not just one or two bars. This is another problem that you see, like with candlesticks. You see 2 and 3 bar formations. 2 and 3 bar formations will not tell you that the trend is turning. They cannot possibly tell you. When you have a trend that's about 300 bars or 200 bars, this trend is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Should be about 20, 30, 40, 50, 60 plus, over 60 bars. So how would you be able to take a look at 2 or 3 bars and say a 60 bar or 65 bar trend is turning with that little sample size? So that's why you see over here that the entire trend, relative to the entire trend, this is the biggest volume on the way up. Relative to the entire trend, this is the biggest volume on the way down. Relative to the entire trend, meaning that is selling on the way up, or profit taking on the way up, and selling on the way down. Alright? With other evidences such as initial distribution and hypodermic maneuvers, all of that together, relative to the entire trend, is telling you something. It's telling you the market is approaching a turning point, and still you may not be convinced. Why? Because no support points have been broken yet, right? So it could be a corrective pullback, on a weekly chart that's going to a daily level or something, or vice versa, pullback on a daily that's going on a weekly level. So this is the challenge. But the volume is telling you there's a lot of people that bought here that are trapped now. They have to break even. Similarly over here, there was a lot of people who bought and got trapped, and when the market went down and reversed, it had to go to that high, and it had to at least chill out. Meaning, even if it doesn't reverse, it's not going to be easy to just go right through there without absorbing. So it gives you some, I don't want to say some degree of certainty, but some degree of what to expect, because if they're trap traders, they're going to have to exit their positions. They will want to get out, break even. That is what traders do. If they're wrong, they hold their position. And when price goes back to that level, they want to get out even. Why? Because of a fear of loss. That's the psychological part of it. But anyway, so we must act in shrewd harmony with these shrewd operators and short. So this is him as an example of shorting the high. Why is he shorting the high? Wyckoff does buy lows and sell highs, by the way. He does it when he has enough evidence that smart money is doing the same thing. Here is clear evidence that smart money is doing that When you have a climax that has a change of behavior, both biggest volume on the way up, biggest volume on the way down after hypodermic maneuver, the market is going to at least chill, just resolve an overbought type of condition. So he's ready to short because other smart money has done the same. All right, we must act in harmony with these shrewd operators. Use the word must. And operators. Who are they? They are the CM. And put out more shorts as the action of the 27th gives us a new selling point. Now, I don't think I went there yet, but action of the 27th. I don't know if this is it. I think this is it right here. Probably here. I really don't know which one it is, but all I know is that he's ready to short up high, and he's ready to short, I think, right here. But for sure, he's ready to short up here. Alright, why? It's the same logic. The same logic that came over here, and you said, okay, the first buy point is if you get, right off the climax, off the low, if you get a very strong change of behavior or heavy buying intraday, he was ready to take the first long here. Same logic is applied here. After this climax, right? Climax here, change of behavior here on 2 bars, right? Change of behavior occurred on the second bar, not 2 bars, but the second bar. Change of behavior here occurred on the same bar as the climax bar. So over here, you had a climax low and then buying what you call volume off the bottom. He was ready to buy that if he got in close enough to the lows. Here you have a climax high, and then you have a change of behavior, but this is not on the same bar like it was back here. Instead, it's on the following day, which is usually more the case, right? So anyway, so as the action of the 27th gives us a new selling point on March 2nd, after a little rally, the average declines 6 points from the high and closes at the bottom. If we have ignored all the previous warnings of the gradual weakening of the technical position, we cannot ignore the decisive breaking of the very backbone of the advance. Very important. I call this the backbreaker bar, but it's really just a breakout. This bar right here. You see this bar? This is a break. Now you say, why is this a breakout? Okay, because up here you have a pivot point. It goes up, down, up, and there's your break. That breaks this low. So it breaks this low. It's a breakdown of this low right here and this area. I don't want to go too much into why this is a breakdown, but that's what it is. So what you usually will see, the climax, then you see change of behavior, and then you'll see some type of breakout. This time it's a breakout to the downside. He calls this, if you haven't taken a short, this is it. This is your clear evidence. It is evidence to take a short. Why? Because it breaks the backbone of the trend. Now there's a couple of things to notice about this. One is that the volume and the range expand. You see the volume here to here expands. Is it the biggest volume? No, but it is increasing volume. The difference between the very high volume, like the biggest volume is 100 days or 200 or whatever, versus just increasing. In general, breakouts will have increasing volume. They do not necessarily need to have the biggest volume in many bars. They just need to have increasing volume in most cases. Here, volume is high. You may look at it and say, no, wait, it's lower than all of these bars up here in that distribution area. But it's still high because of the fact that it is an increase in volume, and a significant increase. If you compare this bar to this bar, it's over 50% increase than the prior day. And the range expansion is very big. So it's a big range bar on increasing volume. Now this is the breaking of the trend. This breaks the backbone of the trend. So here on March 2nd, after a little rally, what is the little rally? I don't know what that little rally is, but I think it's this little rally, or I don't know, goes from low to high. So I'm not sure if this is what he's talking about. It might look like a rally intraday from a low, but after that, this is the backbreaker bar, or the breakout bar, whatever you want to call it. On March 2nd, after a little rally, the average declined 6 points from the high of that day and closes nearly at the bottom, again pointing to what? The low end close. If we have ignored all previous warnings of the gradual weakening of the technical position, we cannot ignore this decisive breaking of the very backbone of the advance. Basically, he doesn't say confirmation, but he says decisive. Decisive meaning, basically, I think it's confirmation, or decisive is like the definitive break of the trend. Alright, so let's take again a look at what's going on here. 1, hypodermic maneuver. 2nd, climax. 3rd, change of behavior. 4th, inability to make a new high on high volume, which is evidence that all this selling or distribution is occurring up here. Now, again, you don't know if this market is going to go higher or lower. Similarly, you had something like that here, where you had a parabolic move or a very high move, and there was one evidence of distribution, which was selling, and the market did not make a lot of progress in the closes. What is the difference? The difference is you did not have a pullback with high volume. You see, over here you had a pullback here, and what's going on with the volume? It's shrinking. Here you had this maneuver going up, this hypodermic maneuver, but what about the volume? Is it shrinking? No, it's advancing, it's high. Now you're looking at the prior bar and then saying it's going down and it's less, but if you compare this volume on the down bar compared to other down bars, it is the highest. Okay, here you don't have that behavior. See, the volume shrinks and it is less than other red bars. Here it is extremely high and increasing much more than other red bars. So there are key differences. And then following all of that shit, you have the breakout right there, which breaks the pivot point, right around here. It basically goes up, down, up, crack. So it's like a high, a low, an attempt to make a high that fails, followed by a lower low, and crack. And I can't really show this without putting it on a wave chart, but if you see, there's a pivot point like in this area. So this behavior shows definitely heavy withdrawal of bids underneath the market, and the volume remains high, very high in comparison to the volume on all previous reactions. This is another thing I want to mention. Like when you're looking at volume, what do? You just look for, it's a big bar. Big fucking thing on the histogram sticking out like that. This is not the way to analyze volume. Let me just go into this. The way you analyze volume is, you can compare it to the prior bar and say, okay, it's increasing, or okay, it's decreasing in this case, right? But also, you want to compare volume from green bar to prior green bars. So even though you have this and this, you want to be able to compare the green bar to the prior green bar and all of the other green bars. That's how he determines a change of behavior. Meaning you have all this shit like going here and here, right? And when he has that change of behavior, the bar or the wave that you're going to be looking at is like comparing this to this down wave and this down wave. It's not necessarily comparing every volume of every bar. It is comparing in two ways. One is the way everyone does it, which is comparing it to the prior bars, right, to see if it's high. The other way is comparing red bars to red bars, or down waves to down waves, or green bars to green bars, up waves to up waves. So therefore, you're comparing rallies to prior rallies and reaction to prior reaction. That's the other way to look at volume. How he determined the change of behavior here was not by taking a look at the prior green bar, but by comparing the volume against prior red bars and determining that the volume was very high. Alright. And over here he says this this is done, so you want to get in around this. Alright, so let's take a look at what he says in the footnote here. We should also suspect when we see such whooping up tactics that informed interests are in a hurry to wind up their campaign. Alright, so their informed interests want to wind up their campaign. When you see that accelerating prices, they might know something you don't, but the public doesn't, whatever. They know something because they see some bad news or adverse conditions in the offing, events not yet apparent to the public, which draws conclusions from. Alright, if you. But the logic of the situation is that large interests have already sold out their long stocks in anticipation of impending bad news, thus creating the supply which starts the market downward before the public is aware of the bearish news. Alright, the other thing is the withdrawal of bids underneath. So what is this pointing to? You see this bar here. It's a big bar, high range bar, big spread, all of that, right? Big range bar, big spread. What is this telling you? Is it telling you that it's just a big bar? No. Why is it a big range bar? It is a big range bar because support, meaning buy orders, have been withdrawn. So when he talks about withdrawal of the bids underneath the market, when this occurs, what do you see on a chart? What you see is a big bar. When the bids are taken away, you will see a big bar. Get it? Because there's no support, so prices can continue, they go down, because if the bids are removed, price has what's called ease of movement to the downside, because those bids have been withdrawn. Who's withdrawing those bids? Traders, big money, smart money. Why are they doing it? Because they know that shorts have been established. They know shorts have been established, so what are they going to do? Say, why are we going to buy pullbacks? Why are we going to buy discounted prices when shorts have been established and the market's going to go down and distribution has occurred? So this is a decisive, almost like confirmation that those shorts have been established. Get out. All right. Here, the reason why this bar is big is because bids, support, buying orders have been withdrawn. And the same thing goes with, the other side. You're going to see like bars expand right here. Why are they able to go up? Because the sell orders at resistance areas, etc., have been withdrawn. If they've been withdrawn, it's easy for price to move up. There is ease of movement to the upside. So that's why you have a big bar. Here, you have a big down bar because the support orders, the buy orders, have been removed from underneath the market, allowing price to make big moves down. Here is the same case. You have absorption completed. Absorption is what? The demand buying the supply. Supply is coming in, the demand is buying it. So because it's buying it, now when it finishes, that demand has been taken out. No more, no more supply. The supply has been taken out. No more supply. What is the result? The result is a big ass bar like this. You see? The expansion of range means that either those buy orders have been removed or those sell orders have been removed, allowing price to have ease of movement. Alright, now that doesn't mean every single time that's the case, but technically when the charts are red, what that's telling you is those orders have been removed. Alright, so like over here, it's a little bit different. This high range bar means that demand has been found at a particular level. So bang, 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 bang. Because of the best prices down here, demand has been found. And that's why the range has been is really big. Here, it means that absorption, meaning demand has absorbed supply, all of it. And now the expansion of range is possible because they've absorbed it. Here it means that the bids, the support orders, the buy orders have been removed from the market, allowing the range to expand. Alright, remains very high in comparison with the volume and all. Okay, I think I went through this. Indicating that very substantial lines of stock are still being pressed for sale by large interests. Having accepted some or all of these bearish indications of the foregoing succession, we conclude that the uptrend has terminated. Alright, so this is very important. How do you conclude that the uptrend has been terminated? It's based on this breakdown. Okay? Now he mentioned 6 days. So 1, 2, 3, 4, 5, 6. From high one, 2, 3, 4, 5, 6. Having accepted some or all of the bearish indications of the foregoing 6 sessions, we conclude that the uptrend has terminated, at least for the time being. Alright, so it's very important to know this, because when you see an uptrend, you can use the same logic to determine whether it has terminated. So now I'm going to go again over that logic. Over here, you have a climactic bar with the biggest volume on an up bar in that entire trend. Following that climactic bar, you have a red bar with the biggest volume on red bars since the beginning of the trend. And you have a close that takes out the prior 2 days closes, so the prior 2 days gain has been nullified, it is gone. Then you have high volume on a subsequent green bar that makes very low progress in the closes, very small amount of progress in the closes, telling you that there is inability to make a new high on high volume. Evidence of distribution also is an evidence of distribution. Finally, you get a breakdown. Alright, so those are at least 4 in the 6 sessions. 1, 2, 3, 4, 5, 6. And putting that logic together, you conclude that for the time being, the uptrend has terminated. So climax, change of behavior, inability to make a new high on high volume with a lack of progress in the closes, followed by a breakdown. Terminates the uptrend. That's the logic. Alright. What did I do to the ruler? Alright, so after running the greater part of December, January, and February, and that a change to a downtrend has begun. This is to say we are entering a substantial intermediate reaction, which may develop into a major reaction. It looks now as if we were correct in our assumption that some distribution was accomplished as early as February 10th. But the main move upward was continued in order to facilitate unloading of stocks which had not topped out. So what does he mean by this? Well, you had preliminary distribution right here, as evidenced by the high volume and lack of progress in the closes. So then why did the market continue to go up? If there was distribution here, the question is, why does the market continue to go up? Isn't distribution supposed to be in a point and figure box and then followed by a breakdown? No. The reason why the market continued to go up is because you have stocks that are in different groups. So you have, for example, healthcare, you have finance, you have the banks, you have all of these different things, right? So what happens is they take turns in distribution. So in every sector, you have a lot of industry groups. They don't all sell at the same time. One gets sold, then the next gets sold, then another gets sold, then another. So they rotate. So what he's saying is over here, you can say, for example, the banks got distributed. So they will stop making that new high. All right? They will stop. Then, then you could say like over here, the healthcare stocks get distributed or whatever. I'm just giving examples. So one industry gets distributed, one industry within the sector, for example, or more. Multiple industries. The point is they don't all get distributed. Some of them get distributed right here, and they're not going to make new highs. They're done. But the market makes new highs because some other industries get distributed higher up. So it's a process of distribution. It's one industry followed by another industry followed by another industry, or a bunch of industries in different sectors. They're all getting distributed. So over here, that's why you have distribution and then a new high, a very strong new high, parabolic high, that offers more opportunity for the rest of the industries to be distributed. That's what he's saying. At this juncture, we should be alert for opportunity to sell short more stocks. Alright, so we'll get into that. The main move was continued, meaning the uptrend was continued to facilitate unloading of stocks which had not topped out. So some of the market topped out, the rest tops out later. They don't all top out at the same time. At this juncture, we should be alert for opportunities to sell more of such stocks as are shown by their individual charts and group charts to be in a weak position. These should be sold short on bulges and the fact that averages have declined from the top about 10 points in an indication of their partway rally, which normally is likely to fall slightly short of recovery of about recent decline. All he's saying is, yeah, you're going to get a pullback after this breakdown, and look at the halfway back point. Alright, so I'm going to stop right here. I think I've covered enough, and we'll continue this some other time. Thanks, bye.